Yes, I like Heikin Ashi candles for exits, and I'm going to tell you my brilliant revelation. Be sure to watch. Hi, this is Tim from TradingStrategyGuides.com. I apologize for my raspy voice today. I don't get sick very often, but my throat is a bit itchy. Today I want to talk about using Heikin Ashi candles as an exit indicator. I know, I showed you the parabolic SAR for exits, but I sort of like Heikin Ashi better. I've compared the two extensively on Forex pairs, and I think Heikin Ashi gives a better indication of the end of a trend. Later in this video, I'm going to ask you to commit to doing something. Then I'm going to ask you to leave me comments about your results. I want to know who's serious about being a professional trader and who's just wanting to be a lottery winner. I get it. We all want to be lottery winners, but that is definitely a low probability opportunity. You have to put in the work to be a successful trader. Don't worry, I'm going to show you exactly what to do in a few minutes. After we look at Heikin Ashi, I've got a new setup on silver that you'll want to see. Oh, and don't forget the brilliant revelation I have for you. It's so simple yet so profound. I wish I could take credit for it. It was revelation to me when I first heard it, and now it's mine, and I'll share it with you. So don't miss it. But first, updates on our open trades, and then later on, the trading maxim for the day. Let's get to it. Remember to click the subscribe button and hit that bell so you don't miss any of these awesome revelations. Let's look at charts. I had EURUSD locked in right here at 110.37 to lock in 22 pips, and look what it did this morning. So I'm done with EURUSD with 22 pips on the second half. 43 plus 22 is not too shabby for our first MA cross trade. I moved the stop up on the Kiwi Swiss to 64.38, which was our original target, locking in 49 pips on the second half on this huge move this morning. Everything's pushing up this morning. This is the crude oil setup I talked about on Friday's video. We got our close below the bear flag right down here at 55.17, so I sold it. We had big volume on that move Friday, so I'm short from 55.17. My stop loss is 57.54, and my first target 53.59. Okay, you ready to discuss Heikin Ashi candles? Here we go. Heikin Ashi means average bar in Japanese. I'll bet you didn't expect Japanese lessons from me, did you? Well, I didn't expect that either. I'm just quoting Investopedia. Up until now, karate was the only Japanese word I knew. Heikin Ashi was developed in the 1700s and is designed to remove much of the market noise from the charts. Most trading platforms that I've used include Heikin Ashi candles as a built-in option for charting. On TradingView, just look up here to the right of the time frame for the little candles. Click on that and select Heikin Ashi. And there you go. The default colors are red and green. And this is MetaTrader. And this is MT4, and I believe Heikin Ashi is included with MT4. But if not, you can find it at the MQL5 code base, and I'll put the link to that below the video. I'm no longer sure what default indicators come with MT4 because I copy my whole MT4 setup over every time I do a new installation. So comment below if you're interested in how to copy your setup in MT4, and maybe I'll do a video about it at some point. A new MT4 installation is a real pain to set up, but much of the pain is removed if you can copy your setup over each time. I like Heikin Ashi because it's unambiguous. Using these colors, if the current candle is blue, you're in an uptrend. If the current candle is red, you're in a downtrend. If you get a change of color, that means you have a change of trend. In this case, blue to red means a change to downtrend. And in this case, red to blue means a trend change from down to up. As always, I wait until just ahead of the candle close to determine whether to close the position or not. We talked about using the parabolic SAR as an exit indicator, so I'm going to show you how to compare the results of these two indicators on this particular Euro-Swissy chart to see which is the better exit indicator. I'll add the PSAR to show you how to compare them. Notice that I use the 0.02 step and 0.2 maximum on MT4 just like I do on TradingView. So let's say you had a signal from your entry strategy to go long here. Now remember, we're not talking about entries right now, so this is purely hypothetical. The Heikin Ashi shows bullish bars up through here until this point. This is the point at which I would consider closing my position. So let's measure roughly how many pips we'll get from this. Heikin Ashi doesn't actually show you the close of the candle, so for the sake of this example, I'm going to assume that the entry and the exit are near the middle of each of their respective candles. So from the center here to the center of this candle, roughly we have about 60 pips. Okay, in this example, you can see that the PSAR is still going strong way up to here. So this obviously caught considerably more of this trend than the Heikin Ashi did. But just for the sake of our back testing, I'm going to assume that our close on PSAR is right about here. Now let's measure from the center of this candle again up to that point, and you can see that we got a roughly 140 pips on this trade. So the PSAR is the clear winner on this particular trend. Now let's look at the very next downtrend. Now since the PSAR did not close the trade until this candle right here, it's possible that we would never have entered this short signal here if our entry system gave us a short signal there. But again, for the sake of this back test, let's assume that we did get a short signal on that candle, and we're going to enter from roughly the middle of that candle, and then the Heikin Ashi gave us an exit signal right here, and again roughly the middle of that candle right there, and let's measure that. So that is roughly 100 pips. Now the PSAR was right here on the prior candle, so I'm going to suggest that maybe give it the benefit of the doubt. Right in there is where the PSAR would have exited the trade for us. So it would have been 1 day later, and we're looking at roughly 53 pips on that trade. So in this case, the Heikin Ashi was the winner. Now, of course, you have to remember that you can't just look at a couple of instances like this and say one is better than the other, but this is the method that I would use to backtest these two indicators to find the best of the two. The idea is to go back 3 or 4 years and look at every instance just like this and write down the results. Do the math. Do the work. Do it on all 28 major Forex pairs. Calculate the results. Then find more indicators and do the same comparison until the best indicator wins. Be honest. Be unbiased. This is your success that you're working on, so don't scrimp and cheat on it. Now I'm going to ask you to commit to put Heikin Ashi candles and PSAR on the same chart and go back in time and see which one is better at signaling a trend ending. Poetry not intended. And let me know what you think in the comments. Do it on lots of charts. Yes, I know it's going to take some time and you're not going to be making money while you do it, right? But guess what? And here's my brilliant revelation for you. You take a few weeks or months now to do extensive backtesting to find the best indicators and strategy for your trading, and you'll have that for the rest of your life. Plus, you'll unlock new skills that will keep you constantly on top of changing markets. Okay? Okay. Let's take a look at the silver trade setup now. You may remember Friday I told you the bullish wedge was one of my favorites. And I showed you one on the weekly Bitcoin. Well, when it rains, it pours, right? I've also got one on the daily silver US dollar chart. A bullish wedge is essentially a triangle consolidation that points down like this here. And for confirmation, you want to see a decline in volume and a decline in volatility just like that right there. So here's the trade plan. We will simply buy a daily close above the bullish wedge. On the breaking candle, to enter a full-size position, you want to see the volume bar reach up to the volume average right here. If it doesn't quite reach the average but does reach at least 75% of the average volume, I'll open a half-size position to reduce risk. You can calculate the percentage by dividing the volume here by the volume average, and you should get 0.75 from that calculation. If you don't get 0.75, stand aside, don't enter that trade. The stop loss will be 1.5 times the ATR, and the first target will be 1 times the ATR. So that means on the breaking candle, let's say this candle breaks here and closes right here. That will be your entry point. You will take a look at the ATR, you'll multiply that by 1.5, and you'll measure 1.5 ATRs below the entry, and that will be your stop loss. Then you'll measure 1 ATR above the entry, and that will be your first target. Now, I had a question the other day, and I think it's a very valid question. A lot of people are concerned about reward and risk in your trading, and a lot of traders will say, well, you've got to have at least 1-to-1 to be a winner, or you've got to have at least 3-to-1 to be a winner, or something like that. The truth of the matter is it depends on your win rate, but it also depends on other factors. And in our case, and in this strategy, the factor here is that we will close a trade if we get a candle close back inside the consolidation here. So functionally, we end up taking much smaller stops than our 1.5 ATR stops. And as a result of that, combined with a pretty decent win rate, this has been a successful strategy. When the price hits the first target, close half the position for profit and set the stop loss to break even on the remainder. We will then follow stops as price moves in our direction until the market takes us out. Now, these two rules are the very definition of cutting your losses and letting your winners run. And typically I do this using two positions. The first position has a stop loss and a take profit associated right with it, and that position will close automatically when the first target is hit. The second position will have the stop loss attached to it, but no take profit directly associated with it. And that's the position that will be allowed to run. When the first target is hit, we will have to move our stop loss up to break even manually on the second position. I will risk about 2% of my account on this trade. And that's the setup on the silver US dollar cross. And just for funsies, I'm going to remind you of the challenge. I want you to put Heikin Ashi candles and the PSAR indicator together on lots of different charts and find out which one works best to signal the end of a trend. Don't forget to comment about your results. I know you're sick of hearing this, but remember, I'm not trying to tell you what to do. I'm just trying to tell you how I handle these trades. If you want more details about what I do, look below this video for a link to my trade management video. But if you've got your own trade management plan, use it. Trading is personal. Things that work for me may not work for you. You have to understand your own mind to find the best strategies for your own trading. And of course, psychology, in my opinion, is the most important part of trading. And the trading maxims are my way of helping to handle my personal psychology. A maxim is a general truth, fundamental principle, rule of conduct, or a proverbial saying. The purpose of my maxims is to motivate me to discipline in trading as well as other areas of my life. I suggest you start your own list of maxims, things that you can say to yourself while you're trading or doing life to make sure that you always do the right thing. Feel free to borrow from my list. And today, Tim's trading maxim number 16. Just because it's a winning trade doesn't make it a good trade. And just because it's a losing trade doesn't make it a bad trade. Good trades follow your plan. Bad trades do not. Don't fall into the trap of thinking all winners are good trades. You have to follow the rules if you want to be a successful trader. You may stumble on a big winner, but that doesn't make you a good trader. Even a blind squirrel finds a nut once in a while. You could just as easily have stumbled on a big loser. Develop your rules. Write them down. Follow them to the letter. Discipline and consistency in all things is primary. Wow, I think my dad just fell out of my mouth. And remember our silver trade plan here. We're going to buy a daily candle close above the bullish wedge. If the volume is not quite average, go half size as long as it's at least 75% of the average. Your stop loss is 1.5 times the ATR, and your first target is 1 times the ATR. And remember to click the link below to the trade management video for more details. And be sure not to miss any of my brilliant revelations. Sign up for my free Trading Picks email list to be sure you don't miss them. I'll be sending out 3 or 4 trading picks a week, everything from stocks to futures to cryptos to Forex, and you'll get to see them first. And the best thing is, it's free. I'll put the link below this video. Be sure to come back to Trading Strategy Guide's YouTube channel every week on Monday, Wednesday, and Friday at 3 p.m. U.S. Eastern Time for my new videos. We'll have a nice trade setup or 2 on each one and maybe some extra Q&A or training. And don't hesitate to ask any questions you may have. I'll either answer your question right in the comments or in a training video or both. And remember, the only stupid question is the unasked one. And don't forget to run the back test with the Heikin Ashi candles and PSAR indicator on all the markets you like to trade. And let me know your results in the comments. Tell your friends about us and help us make this the best trading channel on the internet. As always, thanks for watching, thanks for subscribing, and don't forget to hit the thumbs up below. Have an awesome week, and I'll see you next time.